Hello, everyone, and thank you for joining today. We are here to unravel the complexity of corporate taxation, explore a proposal that could reshape the way we approach it. In response to the challenges posed by multinational companies exploiting the tax disparities, a proposition has been put forth. This proposal suggests a shift in taxation approach for corporation, moving from individual legal entity level to a consolidated group level. The primary objective of this proposed shift is clear: closing loopholes. We aim to create a more comprehensive approach to corporate taxation, one that has been a potential to curtail the evasive practices often employed by these multinational giants. As we navigate through our discussion today, we'll dive into the mechanic of profit shifting, examine real world examples illustrating the challenges, analyze the rationale behind the proposed shift, discuss potential hurdles in its implementation, and explore recommendations to prevent the profit transfer. Now let's start by understanding the fundamental concept of transfer pricing. In the world of multinational corporation, transfer pricing refers to pricing of goods, services, or intellectual properties transferred within the corporation, especially across different countries. It plays a crucial role in determining how profits are allocated among various subsidiaries, impacting both tax liabilities and financial reporting. Financial reporting. Now, moving to our next point, the role. Moving to our next point, the role. The role of transfer pricing in profit shifting. Profit shifting is a strategy where companies manipulate transfer pricing to shift profits from high tax jurisdiction to low tax ones, effectively reducing their overall tax obligation. By adjusting transfer pricing, corporation can allocate higher cost to entities in the higher taxation countries, high tax countries, allowing them to attribute more profit in the entities in low tax jurisdiction. Now let's delve into the specific methods employed for the profit sharing. Companies employ tactics such as underpricing and overpricing, adjusting transfer prices to either underestimate or overestimate the value of goods or services transferred. Intangible assets transfer involves shifting profits by transferring ownership or right to intangible assets like patent or trademarks between subsidiaries. Additionally, debt manipulating using intercompany loan with varying interest rates is another common method to influence the allocation of interest in expenses and profit. In essence, these methods provide corporation with a toolkit for strategically navigate the complex landscapes of international taxation. As we progress, we'll continue to explore these integrities and implications more. Thank you. This was for today. This was for me. I'll now like to transfer the slide to Anishal. Thank you so much.
Thank you so much, Sagar. My name is Nisha Nepali. Now I'd like to talk about an example of common strategies. So understanding this method is crucial to unraveling the intricate web of international taxations. First, we have cost plus pricing. This involves setting transfer price based on production cost plus a predetermined profit margin. It provides corporations with a straightforward way to control profit. Next, we have encounter comparable uncontrolled price. This strategy involves benchmarking transfer by price by comparing them to price changes in similar transactions between unrelated parties. It aims to justify pricing by aligning with the market standards. So the profit split method is another approach. Here, profit are allocated among related entities based on their contributions to the value chains. This method attempts to distribute profit fairly according to each entity's roles. Then there is location saving. The tactic involves attributing higher value to functions performed in low tax jurisdictions. It leverages geographical disparities in tax regulation to shift profit strategically. Lastly, we have the name double iris with dots sandwich. This involves creating complex corporate structure to route profit through low tax countries. a rather intricate strategy, but one that has been employed by several multinational giants. A real world example of multinational corporation attempting to evade taxes by using foreign subsidiaries is Apple. According to a 2017 report by the Australian Taxation Office, Apple has paid only 128 million in tax on its 7.9 billion revenue in Australia in 2016, which is an effective tax rate of 1.6%. The report found that Apple used a complex web of offshore entities to funnel its Australian profit to Ireland, where it had negotiated a tax rate of less than 1%. The report also revealed that Apple had 181 billion of accumulated profit in offshore tax havens, which were not subject to any taxes. So for the next question, I would like to hand over my task to Mr. Mandev. Thank you.
Thank you, Nishchal. Thank you, Nishchal, for your presentation. Now, I'd like to talk about the profit shifting by the multinational firms. Now, let's discuss how the profit shifting operates on a more granular level. First, we discuss excess profitability in tax havens. Foreign affiliates of multinational corporations in tax havens exhibit significantly higher profitability than local firms. For instance, foreign multinational in Ireland may book as much as £8 in pre-tax profits for every £1 paid in wages to Irish employees. This stark contrast primarily reflects profit shifting into the tax haven. Secondly, consider effective corporate income tax rates. The profitability gap between foreign and a local firm is specific to tax havens, as the effective corporate income tax rate decrease, the incentive profit shifting increase. Multinational corporations strategically allocate profits to minimize their tax exposure. In essence, the mechanisms shed light to the indirect dance between multinational corporation and international taxation, where strategic maneuvers can significantly impact the financial landscape. Now let's see the policy responses. As we navigate through landscape of addressing profit shifting, it's crucial to examine the policy response that have been implemented to counter these challenges. Firstly, in 2015, the Organization for Economic Cooperation and Development (OECD) and the G20 launched the Inclusive Framework on Base Erosion and Profit Shifting. The initiative aimed to tackle the tax avoidance arising from mismatch between different countries' tax system, fostering international cooperation. Looking forward towards a more ambitious solution, a coordinated minimum corporate income tax gained traction in October 2021. Over 140 countries and territories committed to this approach, recognizing its potential to significantly reduce corporate profit shifting. Is a testament to the global recognition of the need for collective action. Uh, Now let's see the shifting the landscape from individual entity to consolidate group taxation. Now let's shift our focus to the proposed transformation in the world of corporate taxation. The discussion surrounding a potential move from individual legal entity taxation to the collided group taxation has sparked a considerable debate. This proposal is not a just technical adjustment, it's a significant of fundamental shift. It's designed to address concern related to tax evasion, particularly by multinational corporations strategically liberalizing existing loopholes. Thank you. This much for my part, and rest I want to hand over to Myun. Thank you.
So, okay, I'm Maywen. So why considering this shift in taxation methodology, let's break down to the reasoning behind it. Okay. Shall we go to firstly, so tackling tax avoidance is a primary motivation. And the current individual entity taxation allows multinational corporations to isolate profits in low taxation jurisdiction through subsidiaries. And in this way, reducing their overall tax burden. Consolidated group taxation, on the other hand, combines profits and losses across all the entire group, so making it harder to exploit such loopholes. Secondly, it's about leveling playing field. Traditional taxation disproportionately burdens small companies. They are unable to establish complex structures for profit shifting. And some consolidation aims to ensure that all the companies' operation within a jurisdiction contribute fairly, fostering a more equitable environment. Lastly, the shift in reflecting economic reality reflects sort of the modern business companies today often operate as interconnected groups rather than isolated entities, and consolidated taxation just aligned with taxation with this economic reality, providing a more accurate structure, a group overall financial health. So moving on the next slides, what are the potential benefits? So let's dive into potential benefits that could arise from the proposed shift to consolidated taxation. First and foremost, there's a prospect of reduced tax evasion by closing loopholes using for profit shifting. Consolidated taxation could significantly reduce tax evasion. Consolidated taxation could significantly diminish tax evasion because that's resulting in increase in the revenue for the government. And this is in turn that's increase in transparency, combining financial information across the group, fostering transparency, so make it easier for the authorities to identify the potential tax avoidance schemes. So, and then the third one would be enhancing efficiency. Is a very key advantage because streamlining taxation calculation for consolidated groups could reduce administrative burdens for both companies and tax authorities. So this is a both win-win situation. This increased efficiency might result in more streamlined and effective tax collection process. Lastly, fair competition, which is a level playing field, encourage fair competition, potentially benefiting even the smaller companies currently disadvantaged by the complex structures that would get benefits as well. So this could lead to a more equitable business environment. That's all from me. Thank you.
Hello, myself Sachin Yadav. My part is about challenging an obstacle in implementing consolidated group taxation. First, legal complexity. We confront the challenges of legal complexity. Differing legal system across jurisdiction make harmonization a daunting task. Navigating through its intricate landscape involves determining eligibility criteria, defining groups, and addressing specific scenarios like merger and acquisition, all of which can be legally interactive. And moving on to the administrative burden, we recognize that consolidating financial data from various entities within a group can be cumbersome. Ensuring accurate reporting and compliance add to the administrative workload. Additionally, filing a single consolidated tax return involves coordination among group members, potentially increasing compliance cost. Furthermore, equity and fairness both challenges. Balancing an interest of large and small companies within a group can be intricate. Ensuring fairness in tax liabilities distribution is crucial, especially in the context of intra-group transactions, where determining transfer pricing rules require careful consideration to prevent abuse. Next slide. And the next slide is about enforcement and international cooperation. The firstly, there are enforcement challenges. Enforcement consolidated group taxation across the border involves cooperation between tax authorities. Description in enforcement practice can lead to tax evasion opportunities. Monitoring profit shifting within multinational group require robust information exchange and data sharing mechanism. Consideration international cooperation. Achieving consistent rules and definition globally is essential. Organizations like the OECD plays a crucial role in promoting cooperation and setting guidelines. Bilateral and multilateral agreements become paramount for countries to collaboratively address challenges such as double taxation, transfer pricing, and anti-avoidance measures. Common reporting standards are key in facilitating transparency and reducing information gap. Lastly, legal harmonization is a vital. Developing model legislation for conciliated group taxation can guide country in adopting concedence rule, encouraging non-recognition of tax decision and ruling across jurisdiction enhance cooperation, fostering a more on-file and effective approach. These challenges highlight the intricacies involved in implementing such a significant shift in taxation methodology. And thanks for this one. I will have to call Angina to conclude your presentation.
Thank you, Sachin. Now I'm going to take over the slides. My name is Angela Morrison. So let's explore actionable recommendations for tax authorities to enhance tax transparency reporting. Firstly, there is a suggestion to implement and expand public country-by-country reporting, CBCR, for significant global entities operating in Australia. This would involve providing detailed information on the operations, profits, and taxes paid in each country. Such transparency can empower the public and regulatory bodies with comprehensive insights. Continuing to the monument, the call is to persist in publishing annual corporate tax transparency reports. These reports disclose tax information for large businesses, plays a pivotal role in fostering public debate, and also holding corporate accountability. Regular and accessible reporting contributes to a culture of accountability and transparency. Another slide, please. So moving forward, improving international collaboration and information shareholders. In strengthening regulatory oversight is also another vital recommendation. This involves dependent audits playing a more robust role in verifying financial information. Regular audits can enhance transparency and build public trust. Encouraging disclosure quality is essential, along with urging companies to provide high-quality disclosures, including tax-related informations, and also ensuring clear, accurate, and timely reporting. Lastly, there is a call to engage stakeholders. Educating investors and stakeholders about the importance of tax transparency is recommended, and also encouraging them to consider tax practices when making investment decisions. Additionally, engaging civil society organizations and the media to scrutinize corporate financial reports is highlighted. Their vigilance can play a crucial role in identifying irregularities and promoting accountability. So we can find more conclusion and references below. Thank you.